Good afternoon and welcome to the Thor Explorations investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question received in the meeting itself. However, the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Shagan Lawson. Good afternoon to you, sir.
Good afternoon and good morning or good evening to everyone who's tuned in. I'm very pleased to be here to be talking through the preliminary feasibility study results for the Douta project, which we own in Senegal. Thank you. So first of all, we do have a disclaimer in place. There will be forward-looking statements in this presentation. So we'll just alert our listeners to that. For those who are new to the story, here's an overview of the company. Thor is a West Africa-focused gold producer and developer. We're currently advancing projects in 3 jurisdictions in West Africa, in Nigeria, where we have our flagship gold mine, the Segilola mine, in Senegal, where we've just announced the results of our preliminary feasibility study at the Douta project, and in Cote d'Ivoire, where we moved into in 2024. And we've assembled a very prospective portfolio there with very encouraging initial exploration results. Our Nigeria project is based on an initial open pit resource of just over 500,000 ounces, grading at 4.2 grams per ton. Last year was a very successful year for us in terms of operational efficiency. We produced just under 92,000 ounces of gold, and we did that within our guidance below $1,000 per ounce. This year, we have a production guidance of 75,000 to 85,000 ounces per ounce. That's an all-in sustaining cost guidance of between $1,000 and $1,200 per ounce. At the Douta project, we have increased our stake in both licenses that hold the reserves there to 100% prior to the government 10% free carry. Our global resource now stands just under 2 million ounces, with 1.7 million ounces of that being in the indicated category, grading just over 1 gram per ton. We also now have a probable reserve, which we designed the preliminary feasibility study on, of 1.2 million ounces, also grading at just over 1 gram per ton. We're very encouraged by the results of the preliminary feasibility study, which shows a material economic outcome and a material valuation to us as a company, showing a preliminary feasibility study NPV 5% pre-tax of $908 million at a gold price of $3,500 per ounce. In Cote d'Ivoire, we continue to aggressively carry out exploration on our 3 licenses there: the Guichi project, the Marahui project, and the Bundiali license. Bundiali license, we're doing some lower cost exploration, but as I speak now, we're actively drilling on our Guichi project, and we've kicked off finally on our Marahui project, which we're very excited about as well. And then lastly, as a first mover in Nigeria, we have, in a lower order of priority, assembled an early stage lithium exploration portfolio, which we continue to advance at a low cost. Still, for those new to the story, we are listed on both the AIM market of the London Stock Exchange and the TSXV market of the Toronto Stock Exchange. We had a very stellar year last year in terms of share price performance. We now have a market cap of 1.14 billion Canadian dollars, and I personally believe we still have a way to go in terms of unlocking value for our shareholders across our entire portfolio. We continue to be supported by our institutional shareholders, and as you can see, our broker share price targets still not quite there in terms of both on the Canadian dollar side and obviously correspondingly on the AIM market side. So we are encouraged, and we do believe we will continue to unlock some value. Before I go into the Douta project, I'll just do a quick recap on our performance last year. We started the year on a completely delevered balance sheet. As we went through the year, our margins continued to grow. because we kept the same cost pretty much through the course of the year, whilst the gold price continued to rise. So as of Q3 last year, we had transitioned completely over a 12-month period from a net debt position of minus 27 to an adjusted net cash position of just under $100 million. In Q3, we paid a dividend of 1.25 cents per share. And in 2025 as a whole, we returned around about $18 million to our shareholders in the form of dividends. Our cash position at the end of the year was much higher than budgeted, and we declared a bonus dividend of 1.5 cents. Apologies, not 15 cents, 1.5 cents per share in Q4. So that was all really capped off by a very strong Q4 where we had records by all financial metrics in terms of revenue, profitability, EBITDA. We had a revenue of $108 million. We finished the year with $137 million in the bank and with bullion of just under 3,200 ounces, which were sold in Q1. So the Senegal project, the Douta project, a project which we are extremely excited about. Our land holding here has grown from the original Douta project, which is the brown license you see here, which hosts the Makosa series of deposits. We then acquired the Douta West license, and then last year we acquired the Busankoba license. This Douta project has been organically developed right from grassroots. We actually drilled the first discovery hole in this license, in a grassroots exploration license in 2012, and we've since drilled over 133,000 ounces in the Douta and the Douta West permits. With our indicated resource now at 1.7 million ounces, we've got a discovery cost of $8.50 per indicated ounce, which is highly efficient. It's located in all the right rocks in this right part of West Africa, in the Birimian rocks of the Keneva Inlier, and our total acreage there now stands at 541 square kilometers. The preliminary feasibility study shows, probable reserves now of 1.2 million ounces, and we believe that's growing. We use a long-term gold price of $3,000 per ounce to come up with that reserve, and an indicated resource of 1.7 million ounces, grading at 1.04 grams per ton. We've also added additional inferred resources of 273,000 ounces. The resources have been calculated at $4,000 per ounce, whilst the reserves at 3,000 ounces per ounce. And to recap, we've increased our economic interest now, where the two licenses that host all the reserves, we now own 100% and have 100% economic interest in them. So last year, from March last year to December, we carried out a couple of drilling programs, and that was really designed at increasing the economic ounces. We had an indicated resource of 875,000 ounces, which was our last declared resource. The drilling we carried out, because we knew we were carrying out this preliminary feasibility study, we wanted as many mineable ounces as possible. That drilling was designed at increasing the indicated component of the resource to recategorize that into indicated and then generate a reserve. And that was successful. We had a 94.3 increase in our indicated resource. And unlike last year, we now have a reserve of 1.2 million ounces, grading at just over 1 gram per ton. So a snapshot of the preliminary feasibility study. It's, I think, first and foremost, it's a long mine life of just over 12.5 years. The capex of $254 million is extremely manageable by us, a company our size and our balance sheet strength. It's got a very fast payback at a $3,500 gold price of less than a year, and a post-tax IRR of 61% at a $3,500 gold price. In the first 4 years, this project will produce over 100,000 ounces per year, for a total of 411,000 ounces. And this is all from its 1.2 million ounce reserve. The post-tax NPV is $633 million at a $3,500 gold price, and whereas the pre-tax NPV is $908 million at the same gold price. The reason why I put these two numbers here is because in Senegal, every mining license is individually negotiated with the government, which includes your tax holidays, your investment incentives, which can be applied. For the post-tax NPV scenario, we've assumed we get zero tax holidays and incentives. So in summary, we do expect the post-tax NPV to land somewhere between that $633 million and the $908 million once the negotiations have been complete. The project itself is the production profile is comprised of two phases. The first phase, which is the higher margin phase, is the oxide ore phase, and the second phase is the primary ore phase. The oxide ore phase currently spans for 4 years of mining and processing of the oxide and transitional ore through a conventional carbon and leach circuit. Once we complete that, we then move into the primary ore phase, which runs for another eight or so years through the same circuit. However, due to the more complicated metallurgy and the requirement to unlock components of the gold from silicate, there will be the inclusion of suspension roasting as well. This produces around about 61,000 ounces per year. Project will have very strong early cash flow. In fact, in the first 3 years, even stronger cash flow, producing about 110,000 ounces per year at a cost, all-in sustaining cost of $1,493 per ounce. Like I said, it's very highly leveraged to the gold price. If we use a $4,250 gold price, the project NPV on a 100% equity basis increases to $1.43 billion, with an IRR of 102%. So with the low initial capex, the long life of mine, the all-in sustaining cost for the total project below $1,900, this project does support strong margins throughout the life of mine, and we're extremely pleased with this. And we do believe we can optimize this further over the next 6 to 9 months. The project itself is going to be entirely funded from our cash balance and project financing, and there's going to be no requirement for third-party equity, and shareholders are going to be exposed to absolutely zero shareholder dilution. So the existing resource, this is just a quick illustrative slide, exists in the Douta and the Douta West license. However, we've spent the last 6 months working very aggressively on other areas of the license. We believe that we are going to increase the resource. In particular, we believe we are going to increase the oxide resource and the oxide phase of the oxide ore phase of the project when we get into production. I will start off by illustrating the image on the left, where we have the Makosa deposit and the Baraka deposits. However, we have now delineated 5 targets in the Douta West license and another 6 targets in the Busa and Koba license. We've already kicked off a 40,000 meter drilling program on these targets, and this aggressive drill program we're aiming to start releasing our results on a monthly basis from the end of February. We are going to incorporate these results into an updated feasibility study, and we are targeting and anticipating an increase of the oxide phase of the production. Why are we encouraged by this? If we zoom into the Douta West license, for example, if you look at the Baraka 3 resources, which lie outside these red ellipses, these two, everything circled in the red ellipses are the drill targets we've now defined and designed, they show the exact same signatures as Baraka. If we look at the image on the right, where we do zoom into one of them, one of the ongoing drill programs, these have been designed on soil, geochem, and also rock chip sampling. All these targets are longer than 1 kilometer in strike length. They're potentially open, particularly the ones at the north of Douta West license into Busankoba. There's a significant amount of soil geochem anomalism all throughout this ground that we hold. So we've started drilling these holes. We've also completed a diamond drilling program within Baraka and expect to increase the size of that oxide resource as well. Drilling the oxide over the next 6 months is our top priority, alongside the rest of the development process. Going from there into the Busankoba license, where we've delineated additional drill targets. We do have rig ongoing there, finding some very high resolution drill targets. You can see on the right hand side from the in situ rocks, and the in situ rocks that continue to amplify what we have seen at soil geochem level. There's a significant amount of untested strike length to be drilled, and that's going to be incorporated in our 40,000 meter RC drilling program. So we're seeing high grade rock chip results. We're seeing this over an extensive piece of ground, and we're currently drilling that. And what we're aiming to do, and where we're aiming to culminate that, is to focus on increasing this oxide. So our focus now over the next 6 months, where, like I've mentioned consistently, we're looking to complete this 40,000 meters of drilling. This is all going into a focus of increasing the oxide indicated resource. We believe over the last 18 months, we've been working alongside our EPC contractor that built our mine in Nigeria. We have extremely strong confidence in the pricing we've resulted in, and the level of detail of the quotes, and through that, we believe we have the right sizing of the mill. We believe we've de-risked this project enough to start ordering the long lead items as early as Q2 this year, even before financial close, and possibly even towards the end of Q1 this year. Other focus in the first half of the year will be signing the mining convention with the government of Senegal, and updating our resource and coming up with an updated feasibility study. We do not believe that feasibility study is going to slow down our development process or our development timeline. That feasibility study is clearly to demonstrate additional economic viability of this project, and that will be reflected in the extension of this oxide ore phase of production. When we come to the financing, our strong balance sheet enables us to contribute up to $100 million without impacting the rest of our activities in Nigeria, in Cote d'Ivoire, in terms of returning funds to shareholders in a dividend. And we are looking to fund the balance requirement of $155 million through leverage, whether it's a traditional project finance facility, whether it's a corporate loan, corporate facility at corporate level. We have a lot of optionality here, and we're in a very strong position to fully fund this project. From the discussions we've had, there's very strong early indicative interest. We are accelerating talks now. The preliminary feasibility study has been released, and we're targeting a financial close before the end of June this year. Most of our capex is weighted towards 2027, and even before financial close, we do believe with our funding, we're able to place the order on the longer lead items. 40,000 meters we're actually drilling is targeted at increasing the oxide resource between 200 and 500,000 ounces by the end of Q3. And then based on that, we will be looking at the economics again. What you can see from this Gantt chart, particularly in the post-financial close timeline, is that we can push back the primary ore phase from the end of year 4, and hopefully, much further down the line. Depending on where the gold price is, these two may even run concurrently and overlap for a few years. So to finish off on this, we do have a fast track development timeline. We believe we've done a lot of heavy lifting already to date with our partners. One of the key milestones and gating points to overcome was receiving our environmental and social impact assessment certificate. That was done very recently in Senegal this year, around about 10 days ago. And we are now focusing in country on negotiating our convention. As a top priority, are looking to extend the oxide resources and to update the feasibility study in Q3. And as early as Q2 or end of Q1, we're looking to order the long lead items. We're advancing talks with our financing parties, and we do expect this to close in Q2 this year. And once we've signed this mining convention with the Senegalese government at the end of first half of this year, we believe we're well positioned to pour our first gold the first half of 2028. So that's a very short summary on our preliminary feasibility study. I would personally like to thank all our team and stakeholders that have been involved in getting this out. We are very, very excited by it. We think this is going to unlock a significant amount of value for our shareholders. Right now, the current mine life stands at 12 and a half years. I suspect by the time we pour our first gold, we're going to be looking at something between 16 and 20 years in terms of mine life, and this continues to grow. We're extremely excited by it. We are very well positioned with our EPC partners to get on the ground and get this project up and running. And we're very confident that we will be pouring our first gold within 2 years. Thank you very much.
That's great. Well, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions. You can do so just by using the Q&A tab that's situated on the top right corner of your screen. Just while the company take a few moments to read the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboards. Shagan, as you can see, we have received a number of questions throughout today's presentation, and thank you to all the investors for submitting those. At this point, Shagan, I'll hand back over to you, and I'll pick up from you at the end.
Sure, thank you. Okay, so I will start. I'll read these in order. I'll read the questions out and then I'll answer them. Great job so far in execution. While Thor related, so did many other exploration and developers. Thor being a producer, we expect it to be more leverage. How can we get more traction from Wall Street deep pocket investors? Any plans on upgrading to other exchanges? Unless a 3 mines in 5 years growth plan is made clear and acknowledged widely, I'm afraid may not receive due share price appreciation tax. Yeah, look, we believe we continue to unlock value through what we're doing, obviously producing in Nigeria and then bringing the second project on stream. I believe once we get through that final investment decision in Senegal and officially have updated the Segilola mine life in whatever form it looks like, whether it's additional open pit or underground, and once we're officially a longer term producer, which is hopefully just a matter of time, then we've had these conversations internally, then we will consider looking at bringing ourselves to other exchanges. Can you please provide some feedback regarding the possibility of implementing a share buyback program for 2026? At the moment, we're returning money to shareholders. I think we do our four budgeted dividend payments this year. We'll be returning around about $25 million to our shareholders, and then we have looked at the option of share buybacks previously. The fact that we're listed on AIM and TSXV has additional restrictions on AIM, which include and are really governed by your daily volumes, the amount of shares you can buy back. At the time when we looked, it was deemed extremely inefficient to slowly buy back, tens of thousands of shares over the course of a quarter. We thought that wouldn't be the best use of our cash or very impactful. However, our volumes have increased on both the AIM market and the TSXV market, and it's not something at the top of our priority list right now. We do believe we have much more, should I say, valuable allocations of our capital, but it's not something we're completely closing the door on. Can you put into context the 40,000 meters of drilling plan for this year versus historic drilling to date? Additionally, can you expand on the district scale potential? What sorts of blue sky potential does management see? Yes, look, the 40,000 meters of drilling, I mean, okay, let's look historically. If we start with the drilling we've done to date, those have been over 95% of that has been done in Makosa, and the remainder in Baraka 3. We've now on the ground seen signatures that are very similar to the discoveries we already have. We have a team that's had a very high success rate at a very low cost. We're very confident this 40,000 meters drilling is going to increase our resources from what we've seen on the ground. Right now, we're looking at indicated resources of 1.7 million ounces. I certainly think by the time we pour gold, we are definitely positioned to be well above 2 million ounces, somewhere between that 2 and 2.5 million ounces. And the 40,000 ounces is targeted at adding an initial 200 to 500,000 ounces. That would mean the extension of the oxide phase by 2 to 5 years of low all-in sustaining cost of under $1,500 per ounce, producing north of 100,000 ounces per year, and also considering that phase of the project is already paid back at a $4,250 gold price in 9 months. It's literally just generating very strong free cash flow, north of $300 million annually to the bottom line, if the gold prices stay above 4,250. So you can see how value accretive it is and why it's such a priority to complete this 40,000 ounces. With Douta's strong PFS results and recent share price performance, is management focused on organic growth through resource expansion and development, or are you open to strategic opportunities such as a takeover to maximize shareholder value? I think we've got a fantastic pipeline. We continue to generate strong cash in Nigeria. I think when Douta comes online, that's going to be obviously at a scale much bigger than we've operated in Nigeria. And like I mentioned, after this, the drilling program over the next 6 months, I think we'll demonstrate an even longer mine life than 12.5 years. And then one thing we haven't spoken about in this presentation, because it's been focused on Douta, is the complete blue sky opportunity we have in Cote d'Ivoire as well, which I think will also unlock a lot of value for our shareholders. So right now, particularly given the gold price environment and the fact that we can fund everything ourselves, I think we're in an excellent position in terms of our organic pipeline, and we look forward to delivering that. The bonus dividend is very much appreciated. Can the board take another look at share buybacks? Buybacks are highly earnings per share value accretive and tax efficient for all shareholders. Look, we've just had a very similar question, so I think this is noted, and we will take this away. Management have previously indicated 500,000 ounce oxide resource target. Can management spell out what each additional 100,000 ounce oxide would mean for the Douta project's economics? Yeah, look, I think I answered that question before you asked it, but I'll just reiterate that an additional every additional 100,000 ounces is hugely value accretive. The mine is fully paid off in year one. We're using a $1,500 all-in sustaining cost for the oxide phase and a $4,250 gold price, we're looking at just under $3,000 margin per year. That oxide phase can produce between 100 and 110,000 ounces per year, and that will equate to the bottom line of $300 million per year. So we can certainly hugely increase this project NPV over the next 6 months, and we intend to do so. And that's why this updated feasibility study is such a priority. In saying that, we still have huge confidence in the project as it stands. The economics of the project is de-risked enough that we're going full speed ahead on the development pathline, and that includes ordering the mills in the very near future, even before financial close. If Douta exploration begins to show a significantly larger resource, will management consider increasing the plant throughput size, thereby reducing the all-in sustaining costs? Look, at the moment, we believe we've sized the plant, optimally. It's a 1 gram deposit at the moment. Obviously in Segilola, we've been blessed with very high grade. It's not quite the same here. It's just simply a lower grade deposit. We believe the plant is optimized. The nameplate capacity of 3.5 million tons per annum. If we look at the nameplate capacity in Nigeria versus what we actually ended up producing, I think we've constantly for the last 4 years produced at about 25% above nameplate capacity. So look, not to directly extrapolate, but using the same EPC contractors and the same mills, but perhaps we will be able to push ahead of the nameplate capacity that we have. By how much, I don't know, but I certainly think it's something we'll be able to do. Why does the Baraka 3 resource contribute relatively little to the total resource, and could this change with further drilling? I think that's an excellent and very important question. We drilled out Baraka 3. In terms of geological continuity, we still believe even within the pit shell, there's significant upside that we hadn't infilled in terms of geostatistics, so just closer spacing drilling. So there's resources that lie within the pit, very easy wins, very low cost, low hanging fruit, shall I say, as part of this 40,000 meters to be converted into indicated resources and correspondingly into reserves. We expect the Baraka 3 contribution to increase significantly over the next 6 months. Look, after having delayed the PFS, last thing I wanted to do was to announce another delay to complete this infill drilling. But the project as it stands has excellent economics and will only improve once we complete this drilling of Baraka 3, as well as the other targets I showed in the presentation. Where does the process plant expect to be located and why? The process plant is expected to be located just to the southwest of the Makosa deposit, really, because this is where most of the higher grade ounces currently are, and the Makosa tail is, and we do expect additional upside coming from Usankoba as well as Douta West, so right in the middle of all the resource targets we have. Will mining be done in-house or by a contractor? Currently, we've done our PFS based on using a mining contractor, but obviously that could change over the next 12 months. But currently, the plan is to use a contractor. I'll keep going. Are you considering a TSX listing for the current fiscal year? No, not for the current fiscal year. I think this also ties into the question I just answered about promoting ourselves into a larger exchange. Negotiation with the government in regards to tax, when will this likely take place? Again, that was covered in the presentation, and we hope to have this put to bed by the end of June this year. What is the current royalty rate being paid at Segilola? Has arisen. In Nigeria, the current royalty rate, status quo remains, which is around about $15 per ounce. We are talking with the government. We do expect a rise to about between $30 and $45 per ounce. When do you anticipate filing the NI 43-101 technical report for the Douta PFS? Expect to file it within 45 days of yesterday. There are a lot of questions on Segilola here and my life where I say drilling is ongoing there. So I'll just group all these questions into one. Drilling is all ongoing there, and there are various studies being carried out as well. And we will be looking to update the market around the end of the quarter. Can you clarify the comments about the possibility of running both oxide and primary stages concurrently? Can this be done within the capacity of the planned capex, or will this require a plant upgrade? So yeah, so what I was saying is right now the oxide phase is designed to run from years 1 to year 4, and then the primary phase is designed to come on stream from 5 to 12 and a half. However, if we do extend the oxide phase from years 1 to 8, and we are sitting on surplus cash, the primary phase of the roasting can come in, doesn't have to wait for the oxide phase to end. So rather than producing 100,000 ounces a year from the oxide and then waiting for that to finish and producing 60,000 ounces from the primary, if we are sitting on sufficient cash and we do have the confidence, we can bring the primary phase on stream to produce an additional 60,000 to the 100,000 we're producing from the oxide phase. It's a circuit that can be, the primary output can be added on to once it's been through the roasting, circuit, it can be added into the CIL circuit, and then the output then increases as a whole. But obviously for us, the focus right now is how to extend that oxide phase, and these are great options to be contemplating in a few years' time. Stick to dividends rather than share buybacks. Okay, I think wait for the further update on the lithium project, considering the price increase in lithium. Yeah, look, we're obviously, as a top priority in Nigeria is exploration to extend the mine life. We've put a lot of money into the plant. It's fully repaid. Every ounce we produce there is extremely valuable. So that's taken our top priority, but we are continuing to advance our exploration on our lithium portfolio at a much lower cost and a much slower rate than we have gold. One of the things we did do last year was purchase our own drilling rigs, which has enabled us to drill at a much more cost-effective rate. What we are considering now, or whilst exploration is going, we're probably just waiting for a window where we can relieve one of the rigs from the gold to advance the lithium. But in the background, the drill targets are being delineated, and a lot of work is being done on them, which includes mapping and geophysics. When we do come around to drill them, hopefully we will be ready and we will have a good runway ahead of us to drill. Can you explain why you selected a discount rate of 5% to calculate the NPV? Yeah, we looked at comparables in Burkina, in Cote d'Ivoire, in Guinea, and we looked at what discount rate they used, and they used 5%, and we thought Senegal was similar, if not less risky than the other jurisdictions. However, we have included a sensitivity table, so you can see very clearly the discount rate at 5% and at 10%. Okay. Are you going to Indaba? Yes, I will be. We have a stand at Indaba, and I'll be pleased to be anyone who comes to the stand and answer any questions. Yeah, or even to meet socially. Yeah, look, I think I've covered as much as I can here. There's some repetition in the questions, but if there's anything I haven't answered, I'll be happy to follow up by email. Thank you very much.
That's great. Well, Shagan, thank you very much for your time and for updating investors today. Could I please ask investors not to close the session as you now be automatically redirected to provide your feedback and all the management team can better understand your views and expectations. On behalf of the management team of Thor Explorations, we'd like to thank you for attending today's presentation and good afternoon to you all.